Hello, and welcome to Livewire's Fund and Focus. I'm Huntsley. Thanks very much for joining us. Our guest today is Ryan Quinn of WCM Investment Management. He's here telling you, our Australian audience, a little more about WCM and their specialty area, the Global Quality Equity Universe. Welcome, Ryan.
Happy to be here. Thank you.
So I wonder if you could just give us by way of background. Could you tell us a little bit about WCM Investment Management and the team you work with as well?
Absolutely. We are a greater than $95 billion money management firm based in Laguna Beach, California. Our strategies are concentrated. We believe in high conviction portfolios. We invest in the growth areas of the market. So typically overweight areas like technology and healthcare, niche industrials, and usually underweight areas like energy, real estate, utilities, those types of things. It's important to understand we also take a very long-term view to investing. So in concert with that concentration, we're really acting as owners of the business.
Ryan, there are lots of funds out there which cover quality global growth equities. So how do you define quality growth in the context of your asset class?
Sure, there's some simple things that I think we do that everyone else does. You screen for businesses that are larger cap in nature, businesses that have high and rising return on invested capital, a history of margin expansion and growth, usually a very strong brand, but that's kind of, anyone can do that. Additionally, we like businesses that have pricing power, that have the ability to have very sticky customer relationships and high switching costs. But what makes us different about the way we look at the world and investing is our view on competitive advantages. So in order to own a business, we have to be able to make the case that the competitive advantage of that company is growing versus its peers. And we have to make the case that that growth is going to be durable over the long term.
So if a newbie investor were to look at this fund's holdings, what would you want it to say about your investment strategy and your approach?
I think that there might be a small amount of surprise because we are a growth manager and we are concentrated, but the number of different themes and areas of the broader market that we get exposure to through a select group of holdings is quite broad. So if you think about getting exposure to artificial intelligence or the proliferation of technology through semiconductor chips, we have a number of names that get exposure there. Within healthcare, we have exposure to pharmaceuticals as well as life science businesses. In the financial sector, we've got digital payments, insurance companies, and then when we get into our industrials, that's where things make a bit of a turn. One of our larger industrials holdings is Canadian Pacific Railroad. Not many people go to a cocktail party and brag about the railroad that they own. We own some home building type businesses like Floor and Decor. So I think that the way we invest and the way we get exposure to these very long-term, strong tailwind themes is something that is unique to how we invest in a portfolio that's only 35 to 40 stocks at any given time.
I noticed well that your approach does not really consider macro. Has that been a headwind for you in the last few years, just given how much macro has had an influence on investment returns?
Our position on macro and predicting the macro is that you better make a lot of them because you're going to be wrong most of the time. So rather than spend energy there, we try to really focus our energies on the underlying companies we own and to really understand the competitive advantage of each business. The macro is important. A lot of times it's short-term noise. Usually that short-term noise gives us the opportunity to upgrade the portfolio and get exposure to businesses that we hadn't had the chance to prior.
So given all that you look at, maybe I'd be curious, could you tell us about an out of consensus view that you've got on these markets? Can be about a specific stock or a thematic trade or even a sector as well if you want to go down that path.
We wanted to really understand how our portfolio performed. And so in looking at that, we said, okay, maybe we had a few names that were more correlated to each other than we had previously thought. Why was that? What are the types of things we're exposed to? And so we then went back and looked at a lot of different sub-industries to see which had either accelerated past their pre-COVID growth rate or maybe were lagging below that. And an area where we had a good amount of exposure in terms of luxury had actually outgrown its pre-COVID growth trend. And so an area that we found that we didn't have exposure to and that had lagged its pre-COVID growth trend was aerospace. So think of airplane engines, businesses like GE Aerospace. And what we've seen is that the environment for the aerospace industry has really improved. Travel is coming back significantly. the major commercial airlines are requiring their planes fly for longer now. And so when you own businesses like a GE Aerospace, which sells the engine on effectively all of the middle aisle planes that Boeing and Airbus sell, you sell the engine, that's a revenue source, but there's also long-term maintenance contracts that go with it. So it's a bit of a razor and blade model in that you can not only profit from the sale of your general product, but you also get to profit ongoing as you maintain those machines. So aerospace is an area we're very excited about because it has sort of lagged post-COVID, and we see it trending much back towards trend, if not higher.
So as I understand it, this global growth strategy has been around since 2008, roughly. Quite the baptism of fire, if I think about that time. Given that long track record, then I was wondering if you could tell us about a long-held stock and the investment thesis behind it.
Sure. Well, sort of bridging off the aerospace theme, the way we love to get exposure to these larger themes is in a what we call picks and shovels manner. So not necessarily invest in the company that we think has the best plane, be with the company that supplies the most important thing to the plane, right? Similarly, more directly to your question, owning a company like Taiwan Semiconductor, we own that business since inception of the fund. It did take about an 18-month break during the 2021 period, but it's in the portfolio today. And that's the purest picks and shovels play you can have, because when we first invested in the company, there were about 25 foundries that were creating semiconductor chips, and today there's 2 or 3. And so over time, that industry has really focused into a few players. Taiwan Semiconductor has been one of the survivors because of its consistent commitment to investing research and development. So constantly putting revenues into the ground to make sure that they're ready for the next wave of technology. By owning Taiwan Semiconductor, we get exposure to the growth and explosion of tech, whether it's through cell phones or through high performance computing, electric cars, whatever it is, without having to pick the individual company that's going to win in that scenario. So I think 90% of all the chips that will be generated for artificial intelligence will make their way through Taiwan Semiconductor's fabrication sites. And they are also one of the only foundries that can produce these chips at the leading edge.
And as we know as well, Ryan, global equities, and particularly those with a growth bent, can get very volatile from time to time. Do you have a downside protection strategy for those moments? And if so, what is it?
We do. Historically, our portfolio has captured less than 100% of any drawdown period. And that is especially more powerful the longer you invest with the fund. We generate that characteristic by a few different ways. We mentioned at the top of the interview our focus on quality. Right? One of the things I failed to mention was businesses that have little or no use of debt for their growth. Debt can be really damaging through volatile periods. Typically, businesses that use leverage significantly get sold off the hardest in market drawdowns. So we by our natural tendencies avoid those anyway. Then when you think about my comments around owning businesses that have growing competitive advantages, that's a quality trait that also lends itself to people selling it as a last resort rather than a quick source of funds. And then from a portfolio construction perspective, and lastly, we tend to bucket the types of growth businesses that we invest in one of 3 different buckets: defensive growth bucket, cyclical growth bucket, and the secular growth bucket. We utilize the defensive growth businesses to be the anchor to the wind in volatile periods. And historically, those defensive growth businesses have helped us protect capital so that when we do get maybe a harder sell-off in the secular names, we can take capital from those defensive businesses, load them up into the secular businesses, and capture that eventual recovery that usually comes post-volatile periods.
Ryan Quinn of WCM Investment Management, thank you for joining us, and thank you for coming out here from California as well.
Thank you very much.
And thank you for joining us. If you enjoyed that interview, you can subscribe to the Livewire Markets website, as well as our YouTube channel, where you can find more Funds in Focus. We'll see you again soon.